There's a woman in Guelph, Ontario named Eleanor. She is 68. Last spring, she sat at her kitchen table with her tax return spread out in front of her, and she did something most retirees never do. She compared this year's return to the one from the year before, line by line, and she found something that did not make sense. Her income was almost identical to the prior year. Her deductions looked the same, but her tax bill had dropped by several $100s, and her old age security had crept up, and she could not figure out why. She had not done anything differently. She had not earned less. She had not found a clever new deduction. What had happened was this. While she was living her life, the rules underneath her had quietly shifted. 5 of them, not announced with a letter, not explained on the news, just numbers on a page that moved silently in ways that put money back in her pocket, and in one case set a trap she did not yet know was waiting for her. Eleanor got lucky. She caught the difference because she happened to look. Most retirees never look. They hand their slips to the same preparer, sign the same return, and never know that the ground moved under their feet. Today I'm going to show you the 5 rules that changed for Canadian retirees, the ones Eleanor stumbled onto by accident. 2 of them quietly hand you money. 2 of them are tripwires that punish you if you cross them without looking, and one of them ends a fear that has been driving retirees into expensive mistakes for 2 years. By the end, you will know all 5 and exactly what to do about each. This video is for educational purposes only and is not tax, legal, or financial advice. Everything here is based on current Canadian tax rules and public information. Your situation is your own, so confirm with a professional before you act. My name is David Harper. Every week I break down the CRA rules, the financial traps, and the strategies that protect Canadian retirees from the things nobody else explains. If that sounds like something you need, hit the like button and subscribe right now, and turn on notifications so the next change does not slip past you. Drop a comment right now. Have you ever compared 2 of your tax returns side by side like Eleanor did? Yes or no? I read every single one. Let me start by answering the question I know is already in your head. If these changes help retirees, why does nobody tell us? The answer is uncomfortable, but it is not a conspiracy. The government has no obligation to help you pay less tax. When a change benefits you, nobody profits from making sure you know about it. So, it lands as one line in a budget document nobody reads. When a change can hurt you, the responsibility to track it falls entirely on you. The changes that help you stay quiet. The changes that can hurt you wait patiently for you to make a mistake. That is the whole pattern, and the only protection is understanding the numbers yourself. So let me group these 5 the way they actually behave because that is more useful than a random list. First, the 2 that pay you, then the 2 that trap you, then the one that frees you. Let me start with the 2 that pay you because this is the money Eleanor felt but could not explain. The first one is the rate itself. For all of this year, the lowest federal income tax rate dropped from 15% to 14%. This was the rate cut that took effect partway through last year, which means this is the first full calendar year. You get the lower rate on every dollar in the first federal bracket. 1 percentage point sounds like nothing. Let me show you why it is not. The first federal bracket covers income up to roughly $58,500. The lower rate applies to every dollar inside that band. For a retiree with $50,000 of taxable income, that is around $500 saved per year, automatically with no form to file and no action to take. It simply happens. But the rate cut has a second effect that is easy to miss, and this is the part that compounds. 14% is also the rate used to calculate almost every non-refundable credit you claim. The basic personal amount, the age amount, the pension income credit, the medical expense credit, all of them are multiplied by that rate, and the biggest of those, the basic personal amount, rose this year to $16,452. That is the slice of income every Canadian earns completely free of federal tax, and it is the highest it has ever been. For a couple, 2 basic personal amounts shield close to $33,000 of household income before a cent of federal tax applies. That is the first thing that quietly put money in Eleanor's pocket. A lower rate and a bigger shield working together, she never filed anything to get it. It arrived as a slightly smaller number on the bottom of her return, and she only noticed because she compared 2 years side by side. There is one more thing worth saying about that rate cut because people underestimate it. A single percentage point on the first bracket does not sound like much in any one year, but retirement is not 1 year. If you are 65 today, you may be drawing income for another 20 or 25 years. That 1 point applied every year across a long retirement and applied not just to your tax, but to the value of every credit you claim quietly compounds into many thousands of dollars over the life of your retirement. The changes that feel too small to notice in a single year are often the ones that matter most over a lifetime, precisely because they apply to every year automatically, whether you are paying attention or not. Eleanor felt 1 year of it. The full value is 20 years of it stacked. The second rule that pays you is one that is yours specifically the day you turn 65. It is called the age amount, and it is a federal credit available only to Canadians 65 and older. This year, the base amount rose to $9,208. At the 14% rate, that is up to $1,289 in federal tax savings. Add the matching provincial age credit, and the total reaches somewhere around $1,800 to $2,000 a year, depending on your province. For a couple where both spouses are over 65, that is 2 age amounts, potentially more than $2,500 a year in combined savings, simply for being the age you are and filing correctly. That is the second pile of money. So far, so good. But the age amount is also where the first trap hides, and this is where we go from the rules that pay you to the rules that trap you. The age amount does not stay full, no matter what. It is income tested. The moment your net income climbs above roughly $46,432, it begins to shrink. For every dollar above that line, you lose 15 cents of the credit until it vanishes entirely a little above $107,000. Here is why that matters more than it sounds. Think about how a retiree funds their life. Most of the money comes out of a RRIF, and every dollar pulled from a RRIF counts toward your net income. So a large RRIF withdrawal does not just get taxed. If it pushes you over that $46,000 line, it also quietly erodes your age amount on the way up. You pay the tax on the withdrawal, and you lose part of the credit at the same time. 2 costs, 1 withdrawal, and nobody warned you about the second one. The retirees who understand this calibrate their withdrawals. They keep their income just under the line where they can, preserving the full credit. The ones who do not understand it watch their tax bill creep upward year after year and never connect it to the withdrawal that caused it. Your software will calculate the age amount for you. What your software will not do is tell you that one extra RRIF withdrawal in December just cost you part of it. The second trap is bigger, and it is the one that can do the most damage. It is the Old Age Security Clawback. Officially, it is the OAS recovery tax, but everyone calls it the clawback, and here is how it works. Once your net income climbs above a threshold, the government begins taking back your OAS at 15 cents in every dollar over the line. Go far enough over, and the entire OAS payment disappears. This year, that threshold rose to $95,323. That increase is genuinely good news because it gives you more room before the clawback bites. But you have to understand the mechanic because it is one of the cruelest in the whole system. The clawback is a 15% surcharge stacked directly on top of your regular tax rate. So a retiree crossing that line is not just paying their normal rate on the next dollar. They are paying that rate plus 15 cents of clawed back OAS on top. For many retirees, that pushes the real cost of income above the threshold past 50%. And here is the part that quietly ruins people. The threshold is per person, not per couple. As long as a couple splits their income evenly, they each get their own threshold and they are protected. But once one spouse is gone, the surviving spouse often inherits a chunk of that income and now files a loan against a single threshold on income that used to be shared by 2. That is the survivor's trap. The same household income that was safely split between two people suddenly lands on one person and triggers a clawback that never touched them before. It is one of the most painful surprises in Canadian retirement, and it is entirely a function of that one threshold and who is standing on which side of it. So those are the two traps: the age amount phase out at $46,400, the OAS clawback at $95,300, both triggered by net income, both quietly punishing the retiree who withdraws without looking. Now the fifth rule, the one that frees you because it is the answer to both traps and the most quietly powerful change of all. For 2 years, a fear hung over retirees with cottages, rental properties, and investment portfolios. The government had proposed raising the capital gains inclusion rate from 50% to 66.67% on larger gains. The proposal sent a wave of panic through the retirement world. People rushed to sell cottages early to trigger gains before the change, to lock in the lower rate while they still could. Advisors were booked solid. Many retirees paid tax years earlier than they needed to out of pure fear of a change that had not even been finalized. And then, quietly, it was canceled. As confirmed by Scotia Wealth Management, the Canadian Federation of Independent Business, and the major accounting firms, the inclusion rate stays at 50%. The 66.67 proposal is gone, not deferred, not coming back through a side door, abandoned. That removes the panic. But that is not the part that frees you. The part that frees you is the other tool that quietly grew this year, and it is the direct answer to the two traps we just walked through: the tax-free savings account. The TFSA annual limit is $7,000, and the cumulative room for someone eligible since it began who never contributed is now $109,000. For a couple, $218,000 of room. And here is why it is the single most important tool in this entire video for a retiree. Remember the two traps. The age amount phases out on net income. The OAS clawback hits on net income. Money you pull from a RRIF counts toward that net income and pushes you toward both, but money you pull from a TFSA does not. TFSA withdrawals are invisible. They do not count toward the OAS clawback. They do not count toward the age amount phase out. They do not generate a slip that lands on the CRA's desk. They are completely outside the income calculation that governs every other rule we have discussed. Do you see what that means? The TFSA is not just a savings account. It is the control valve. Every dollar of your retirement spending you can shift from the RRIF to the TFSA is a dollar that does not push you toward the age amount phase out, does not push you toward the OAS clawback, and does not raise your tax bill at all. The two traps are both triggered by income. The TFSA is the one source of money that is invisible to income. It is how you fund your life without stepping on either tripwire. And the room just grew again this year. Most retirees treat the TFSA as a place to park spare cash. The ones who understand these 5 rules treat it as the master switch that controls every threshold in their tax picture. Let me make this real with numbers, because grouped together, these 5 rules are worth far more than they look one at a time. Go back to Eleanor in Guelph. She is 68, on her own for 2 years now, living in the house she and her husband bought in 1989. She has a RRIF of $320,000, a TFSA of $90,000 built up over years of saving, and CPP and OAS that together bring in about $28,000 a year. With a modest RRIF withdrawal on top, her income sits in the low 50s. Watch how the 5 rules play out for her. The rate cut and the higher basic personal amount quietly trim a few $100s off her federal tax. The difference she noticed but could not explain. Her single age amount, because she's just over the 46,000 line, is partially reduced. But by managing her RRIF withdrawal carefully, she keeps most of it, worth well over $1,000 in combined federal and provincial credit. Because she is now a single filer, the OAS clawback threshold matters enormously to her, and she sits comfortably below the 95,000 line. So her full OAS is safe as long as she does not take a large RRIF lump sum that pushes her over it. And the cottage. Eleanor and her husband bought a small cottage on Georgian Bay decades ago. In the middle of the capital gain scare, her first instinct was to sell it and lock in the rate before the change. Had she done that, she would have triggered a gain of roughly $200,000 years before she needed to, paying tens of thousands in tax early and losing the use of that money. Because the proposal was canceled, she kept the cottage. That single avoided mistake is worth more than every other change combined. Then there is her TFSA. Here is where the real strategy lives. In a year when her RRIF income is already close to the age amount line, instead of taking more from the RRIF, Eleanor draws from her TFSA. That money funds her life exactly the same way, but it does not count toward her income, does not erode her age amount, does not threaten her OAS. By using the TFSA as her control valve, she keeps her taxable income low, preserves her credits, and protects her full benefits. Conservatively, that coordination is worth another $2,000 to $3,000 a year. Added up, in a single year, Eleanor is protecting somewhere between $4,000 and $6,000 through deliberate use of these 5 rules, plus the one-time avoidance of a cottage sale that would have cost tens of thousands. Over a 20-year retirement, the recurring savings alone compound past $100,000. $100,000 on an ordinary single retiree's lifetime, simply from understanding 5 rules that moved quietly and planning around them. Now I can already hear the objection. David, I do not have a cottage. I do not have 90,000 in my TFSA. Does this still apply to me? More than ever. And here is the counterintuitive reason. The lower your income, the more devastating it is to lose a benefit you were entitled to. A wealthy retiree who loses part of their age amount barely notices. A modest retiree who loses their age amount, or worse, triggers a clawback of an income-tested benefit because they did not understand how RRIF income interacts with the thresholds, can lose a real share of their entire annual income. For lower-income retirees, the 5 rules simply play out on a different stage. The rate cut and the higher basic personal amount shield more of your modest income entirely. The age amount is a larger share of the little tax you owe. The OAS clawback may never reach you, but the GIS clawback absolutely can, and it is even more brutal, taking 50 cents of benefit for every dollar of RRIF income from the very first dollar. The same TFSA strategy that protects a wealthier retiree's OAS protects a modest retiree's GIS. For someone living mostly on CPP, OAS, and a small RRIF, the TFSA is the single best place to hold every spare dollar, precisely because it is invisible to the clawback that would otherwise punish them hardest. The principle is universal. The rules moved. Nobody told you. And whether you are sitting on a paid-off house and a cottage or living carefully on a government check, the same truth holds. The dollars you keep are the dollars you understood well enough to protect. I want to slow down on each of the 2 traps for a moment because understanding the mechanics is the difference between avoiding them and walking straight into them. Start with the age amount phase out because it is the one most retirees trip over without ever realizing it happened. Picture a retiree whose net income lands right around $50,000. They are a few thousand over the $46,400 line, so part of their age amount has already quietly eroded. Now imagine their furnace quits in November and they need $8,000 to replace it. The natural move is to pull that $8,000 from the RRIF. It feels harmless. It is their money. But that $8,000 does 3 things at once. It gets taxed at their marginal rate. It pushes them further past the age amount line, shaving another $1,200 off the credit at the 15% reduction rate. And depending on their province, it may nudge other income-tested benefits as well. The $8,000 furnace did not cost them $8,000. Once you count the tax and the lost credit, it cost closer to 10 or 11. Had they pulled $4,000 from the RRIF and $4,000 $4,000 from the TFSA, the damage would have been roughly half. Same furnace, same warmth, very different tax outcome. That is the kind of decision that happens at kitchen tables across the country every winter. Almost nobody runs the second calculation. Now, the OAS clawback, because the survivor's trap deserves a closer look. Consider a couple, both 70, each receiving full OAS, with a combined income that they have carefully kept split down the middle. So neither of them is anywhere near the 95,000 line. They have done everything right. For years, their OAS is completely safe. Then one spouse is gone. The surviving spouse inherits the other spouse's RRIF, rolled over tax deferred, which is the humane part of the rule. But now that larger RRIF generates larger mandatory withdrawals, and those withdrawals land on a single tax return against a single threshold. The income that two people used to share is now concentrated on one, and suddenly the surviving spouse, in the hardest year of their life, crosses the clawback line and watches a chunk of their OAS get taken back. On top of losing the ability to split pension income, on top of moving into a higher tax bracket as a single filer, this is not a rare edge case. It happens to a large share of surviving spouses, and it is almost never explained in advance. The defense is to plan for it before it happens, drawing down the RRIF more aggressively while both spouses are still here and both thresholds are available, shifting wealth into the surviving spouse's TFSA, where it will never count against them. The survivor's trap is built into the per-person design of the threshold. You cannot remove it, but you can plan around it, and the planning has to happen while both people are still here. I want to come back to something I said earlier because it deserves more than one line. I said the system is not built to inform you, and I want to show you exactly how that plays out because it is not abstract. It happens every filing season to real people. Picture a man, 71, who has used the same tax preparer for a decade. Every spring, he gathers his slips, drives to the same office, sits down with whoever is free, and signs what they put in front of him. This year, the preparer, processing dozens of returns a day in the crush of the season, runs his return the way he always has. He does not stop to ask whether the RRIF withdrawal could have been timed to preserve more of the age amount. He does not flag that shifting some of the draw to the TFSA would have protected a benefit. He is not a bad person. He is a busy one. And the software did what it always does. The man leaves having paid a few $100s more than he needed to, and he will never know because nothing on the return is wrong. Nothing was filed incorrectly. He simply did not capture value that was sitting right there, available to him, because no one in the chain had the time, the knowledge, or the reason to find it for him. Multiply that by the millions of Canadians who file exactly the same way every year, and you start to see the true scale of what quietly goes uncaptured. Not through fraud, not through any villain, through ordinary, indifferent machinery that was never designed to hand you anything you did not ask for by name. And that is the real lesson underneath all 5 of these rules. The changes themselves matter, the rate and the age amount, and the clawback and the capital gain certainty and the TFSA room. But the deeper thing is the realization that the responsibility is yours. Once you internalize that, you start doing the small things the prepared retirees do. You compare 2 returns side by side, the way Eleanor did. You ask your preparer a pointed question instead of just signing. You check your contribution room before December. You time a withdrawal around a threshold instead of pulling money whenever you happen to need it. None of these moves is complicated. None of them requires being wealthy or sophisticated. They require only the knowledge that the lines exist and the habit of looking before you act. Think about the difference between 2 retirees with the exact same income, the same house, the same RRIF, living in the same town. One of them treats their finances on autopilot, withdrawing money whenever it is needed, signing whatever the preparer prepares, never looking at a threshold. The other understands the 5 rules, times their withdrawals, splits their pension income, uses the TFSA as a control valve, and checks their return against the prior year. Over a single year, the gap between them might be $3,000 or $4,000. Over a 20-year retirement, it is the price of a car, a decade of travel, or a meaningful inheritance for their children. Same income, same starting point. The only variable is knowledge and the willingness to act on it. That is the entire game. A dollar drawn from a RRIF and a dollar drawn from a TFSA buy exactly the same groceries, heat exactly the same house, fund exactly the same life. But one of them counts toward every threshold in this video, and the other is invisible. The retiree who understands that difference and plans around it keeps thousands more than the retiree who never thinks about where the dollar comes from. The rules changed quietly this year, but the deeper game has not changed at all. It is and always has been about the numbers, the thresholds, and which side of them your income lands on. I want to give you one specific tactical move for each rule, because the headline of each change is only half the story. On the rate cut, the retirees who benefit most are those whose income sits squarely in the first bracket, below $58,000. If that is you, nearly all of your income now enjoys the lower rate. You are in the sweet spot. On the age amount, the most common mistake is taking a large RRIF withdrawal in December without checking whether it pushes you over the phase-out line. If you need a large withdrawal, consider splitting it across 2 calendar years, late December and early January, so neither year crosses the threshold. That one move can preserve hundreds of dollars in credit. On the OAS clawback, because the threshold is per person, pension income splitting between spouses is one of the most powerful tools you have. Moving eligible pension income from the higher-earning spouse to the lower-earning spouse can keep both individuals below the line and protect both OAS payments. For couples, this is not optional. It is the core defense against the clawback. On capital gains, now that the rate is locked at 50%, the smart move is to plan the disposition of an appreciated asset deliberately, spreading the gain across years where possible, so it never spikes your income into a clawback or phase-out in any single year. Certainty is what lets you plan. Use it. On the TFSA, the most underused strategy is the deliberate RRIF to TFSA shift in a low-income year. If you have a year where your income dips, draw a little extra from the RRIF, pay the modest tax, and move the after-tax amount into the TFSA. You are converting taxable, threshold-counting money into tax-free, invisible money permanently. Every year you do this, you shrink the part of your wealth the CRA can see and grow the part it cannot touch. Now let me say the thing that ties all 5 of these together, because it is the most important sentence in this video. The system is not built to inform you. It is not broken. It is not an accident. It is working exactly as it was designed to work. The CRA earns nothing by telling you about a credit you are owed, so it does not. Your tax software does only what it was programmed to do, and the programming lags behind the rules. Your preparer is a decent person, buried under hundreds of returns in a few short months. The new thresholds do not all make it into their head in time. Nowhere in that entire chain is there a single person whose job depends on making sure that you, by name, keep the most of your own money. That job belongs to exactly one person, you. Nobody's going to phone and tell you the age amount line moved. Nobody's going to warn you before you step over the clawback threshold. Nobody's going to remind you that your TFSA room grew again. The retirees who accept that the job of protecting their money is theirs alone are the ones who quietly keep thousands more year after year than the retirees who sit and wait to be told. The waiting retiree gets exactly what the system intends them to get, less. So, here is what to do this week. 5 actions, 1 for each rule, and none of them takes more than a phone call or a few minutes with your own paperwork. First, look at your most recent notice of assessment and confirm your tax was figured at the lower rate and that your full basic personal amount was applied. If something looks off, you can adjust it. Second, if you are 65 or older, confirm your age amount was claimed and find out where your net income sits relative to the $46,400 line. If you are close, plan your next RRIF withdrawal to stay under it. Third, find out exactly where your income lands against the $95,300 clawback threshold. If you are anywhere near it, plan every large withdrawal around that line. And if you are a couple, make sure you are splitting eligible pension income to keep both of you below it. Fourth, stop worrying about the canceled capital gains proposal. The rate is 50% and it is staying there. Put that energy into understanding how the deemed disposition will affect your cottage, your rental, or your portfolio when those assets eventually change hands. That is the real exposure. Fifth, check your TFSA contribution room today by logging into your CRA account. Every dollar you can move from a taxable account, or RRIF, into the TFSA is a dollar that escapes the age amount phase out, the OAS clawback, and the tax bill entirely. Treat it as the control valve it is. Do those 5 things and you will have handled every change the CRA made this year without telling you. Before I let you go, I want to be honest about one thing. Eleanor is a real kind of person, but the exact numbers are an illustration. Yours are different. Your province, your income, your home, your accounts, all different. The 5 rules are universal. The dollars they are worth depend entirely on your specific situation. So before you act, run your own numbers and bring them to a qualified professional who can confirm how each one applies to you. And 2 quick questions because your answers shape what I cover next. First, which of these 5 changes did you have no idea about until right now? Drop the number 1 through 5 in the comments. If it was more than 1, drop them all. The change that comes up most becomes its own full video. Second, here's a simple one. Are you going to check your TFSA contribution room this week now that you know it is the control valve? Type yes or no. I read every single comment and that one word tells me how many of you are ready to act. If even one of these 5 was new to you, the system did exactly what it was designed to do. It kept you in the dark. The best way to fight that is to make sure the people you love are not in the dark either. So if this was useful, hit the like button and subscribe so the next change does not slip past you. And send it to one person over 65 who is still paying the CRA more than the law requires. Take care of yourself, and I will see you in the next one.